The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. I'm Kendall Trump with Grain Journal Magazine in Decatur, Illinois. Welcome to The Importance of Risk Management to Grain Elevators and Their Customers. This is the seventh in a series of webinars to be presented by GEAPS in Grain Journal Magazine in 2019. Today's webinar is sponsored by M&M Specialty Services. M&M specializes in protecting your people and your products with the best in quality and affordability in personal protection products, grain protectants, fumigants, and services. They are based in Leavenworth, Kansas. This webinar is also sponsored by VAA LLC, who has provided engineering and design services in the agribusiness industry since its founding in 1978. Working with owners, equipment vendors, and design-build contractors, the firm specializes in bulk commodity handling facilities, including slip-form design, material handling, transportation, and export. They are based in Minneapolis, Minnesota. Today's presenters are Richard Jelinek and Jake Moline of INTL FC Stone Financial. Richard is Vice President and Global Education at INTL FC Stone Financial. He develops price risk management programs and materials on agricultural futures, options, and OTC markets. He has 34 years of experience at the CBOT and CME Group, where he focused on price risk management training in Europe, Asia, Middle East, Latin America, and the United States. And Jake is a commercial grain risk management consultant based in West Des Moines. Moline is a graduate of Iowa State University with a degree in ag business and economics. You can participate in the Q&A session today by typing in the questions box at the right-hand side of your screen at any time during our presentation. We will be addressing your questions during the Q&A session following our presentation. We do have two polling questions for you today. First, how many people are viewing at your facility? Okay, and next, are you a GEAPS member? Thank you all for your participation. As a note, today's webinar is being recorded and it will be posted to our website, grainnet.com, within 24 hours. All registrants will also receive an email containing a link to the webinar recording and the presentation slides. Richard, at this time, can you please do a voice check?
Good morning, Kendall. Good morning, everyone.
Thank you so much. And now, can you please show us your screen? Richard, are you able to bring up your presentation?
It is up.
We are viewing your email currently.
Okay, that's not good. I'm trying to think how to switch it over.
Okay, real quick, I'm going to take back the presenter controls, and when I hand them back to you, you can choose which screen you would like to show. There we go. Ladies and gentlemen, here is Richard Jelinek.
Thank you, Kendall, and my apologies to everyone for the technology glitch there. As Kendall mentioned, my name is Richard Jelinek, Vice President, Global Education. In short, that means I'm a teacher, and I travel all over the world teaching about my passion, which is agricultural price risk management. First of all, I'd like to thank Kendall, the Grain Journal, and GEAPS for the ability for INTL FC Stone to be a part of their education series. So let's, without further ado, let's get started into the presentation. First slide is always the all-important disclaimer, basically saying that my partner and colleague and friend, Jake Moline, and I, we did our best to make sure that all the information is accurate. So, importance of price risk management. A lot of people out there in agriculture, whether they're buyers of commodities, sellers or producers of commodities, or even merchandisers of commodities, they hear about this subject and they want to jump right into it and learn about all the different ways and the mechanics of risk management. But I think as a teacher, the most important thing to do up front is learn why. Why is risk management so important to your business? And so we're going to spend a few slides on that. Is price risk management difficult? We asked this gentleman in this elevator here. The response is no. Just remember, complex concepts, stated simply, creates opportunity. And that's what we attempt to do in our educational efforts, is take concepts that are perceived by many to be complex and break it down so that everyone understands it. After all, if you can't understand the subject, how are you actually going to be able to implement it effectively into your business? So that's our goal today, is just to give you an overview of this concept and show you that it isn't, or it doesn't have to be all that complex. And the other elevator operator, he says, really, with more focus on risk management, I can get more grain origination. And that's what it's all about, being a grain merchandiser. See, the concept of risk management isn't just for the merchandiser, the elevator operator, the manager of the co-op. It's for anyone that's buying and selling agricultural products. And by offering all different forms of risk management to customers, merchandisers, through that process, can get more grain origination. And isn't that what it's all about from an elevator perspective? So the success of price risk management depends on two features. Success favors the prepared. Now, what does that mean? Well, everyone that's listening in on this webinar, or someone who will watch it later when it's archived, you already took the first step, and that's education. An attempt to learn as much as possible about risk management and how to go about managing risk of your business. Success also favors those willing to change. Now, one of the negative aspects of a webinar as a teacher, I don't have the ability to see who I'm talking with. I'm not sure what age you're at, so I'm going to make an assumption that some of you might have been around the block a few times, and maybe a little on the stubborn side, might even be the type of mentality saying, well, my grandparents did it like this, my parents did it like this, so I'm going to do it like this. And in some cases, some things, it could be just fine. But again, if you're not willing to change, if you're not willing to look at other ways of running your business, you might be missing out on some great opportunity. So a merchandiser's pretty picture, obviously they have their own management and they have customers. And the trick is to make everyone happy. Without this concept of risk management, however, things can get pretty ugly pretty fast, both with customers on the buy side and the sell side, and ultimately your own management. And what could be hurt without risk management is the bottom line, so profitability. From a merchandiser standpoint, the margins can simply melt away. Now, almost every one of you being in business are aware of all different types of risk of running your business. From the equipment you have, the facilities you have, vehicles, transportation, even staffing. There's all kind of risk with those, and you're familiar. They're just everyday business risk. And how you deal with them is usually some form of insurance. You don't like paying those insurance bills, but you do. It's necessary. But even a business that acknowledges all that, sometimes they overlook a risk that is hitting them right between the eyes every single day, every single minute of the market day, and that's your price risk. Grains and oilseeds, some of you might be on the livestock side, energy, interest rates, currencies. These are risks that are real, that are happening all the time, and some of you might be focus solely on grains and oilseeds, and you're like, well, that's one I'm going to focus on. I don't need to worry about energy. Well, I think everyone on the phone, I'm going to make another assumption that you're using some form of energy to run your business. And that risk is real, just like in the grains and oilseeds and all the agricultural markets. Interest rates, again, another assumption. I'm going to make the assumption that none of you have all the money in the world. So you're always in need to borrow money, whether on the short term for an operating loan, longer term, maybe you want to expand your operation, but interest rates can impact your bottom line as well. And if any of you are dealing outside our borders, you have to deal with the risk of other countries' currency. So my simple statement here, know all your risk, not just the obvious business ones, but the ones that are real, that impact the commodities that you're involved with, and then learn how to manage them. So let's talk about volatility. This is kind of a fancy word that a lot of analysts out there throw out all the time without really explaining it. So I'm going to start out with a few charts and bring out a few concepts that'll be of importance to you. Corn volatility. What usually happens in the summer months? Well, you're going to see the arrows pointing it out. It's pretty obvious already that usually in the summer months, the markets can get pretty volatile, especially in the grains and the oilseed markets. If you're following the markets or you have a consultant that is talking to you about the markets all the time, you'll see when this volatility will peak. You'll see the seasonality in these markets. Another one to show you the other part that we already discussed, your energy risk. And just like in the corn market, you see significant volatility in these markets as well, from gasoline to diesel to natural gas. And here's the interest rates. Again, pretty volatile. But some of you may have been around a while. You're looking and say, well, that's not too risky. If I'm going to borrow money, that red trend line is pretty good. It means that rates keep going lower. And that's good for me as someone who has to borrow rates. But what if times are changing? The first 6 months after our last presidential election, interest rates went up 1 full point. Just think to yourself, if you had to borrow money at 1 point higher than what your current rates are, that would have a direct impact on your bottom line. What if they went up 5 points, 10 points? What if interest was over 20%? If you had to pay over 20% money on your loans? Now, some of you, again, make an assumption, some of you probably haven't been in business as long as this chart goes back. And you might be saying, 20% interest? That's impossible. I've never seen anything close to that. Again, another assumption that some of you have been around the block for a while. You can attest to the fact that we've had interest rates well over the 20% level. Think what kind of impact that would have on your bottom line. Again, a reason that you need someone to look at these markets, not just the one of your primary focus, but all the markets that impact your business. And again, the solution to managing all these risks, whether it is in grains, oilseeds, livestock, energy, interest rates, currencies, is price risk management. The concept price risk management applies to just about every market you're involved with. So let's get into this volatility. Again, this high-end word, volatility. Well, I'm going to show you some basic math, and that's what I said was one of my skill sets, is taking something that is perceived to be complex and breaking it down so everyone understands it. In our example here, we have corn at $4.50. And we're going to look at 3 different market environments in terms of volatility, 10, 20, and 30%. For math purposes, let's look at 10%. Multiply 10% times $4.50 and you get 45 cents. You add that 45 cents and you subtract 45 cents from $4.50 and you will see a range of 405 to 495. Theoretically, with 68% probability, 10% volatility is telling you that between now and 1 year from now, these are annualized volatilities, corn should be somewhere between 405 and 495. At 20% between 360 and 540, at 30%, 315, and 585. So as you can see, the math is not all that difficult. But now here's a question. At what volatility level is your risk the greatest? I'm going to make the assumption we have some producers on the line. As a producer or seller, which of the 6 numbers in the right column would you not like to receive for your corn? Obviously, it's the $3.15, which translates into the higher volatility level of 30%. For the consumers, the buyers of corn, which of those 6 numbers would you hate to see? Obviously, the 585. Again, it translates into the 30% volatility level. You see, volatility is not biased in any one shape or form. It impacts both the buyers and sellers. So hopefully you could understand a little bit more now about volatility, what it stands for in terms of risk, and how to mathematically calculate it. And some of you might say, okay, let's move on to the next slide, but we can't because there is one more question. At what volatility level is your opportunity greatest? See, volatility is a measure of your risk, and a lot of people accept that and assume that and figure that's it. But volatility is also a measure of your opportunity. So looking at the 6 numbers on the right side, as a producer, which of those 6 numbers would you love to see? Obviously the 585, and a consumer would love to see the 315. Surprise, it's at the same high volatility level. So the point here is when you see a high volatility level, that's nothing to shy away from. It's very important because it's a measure of your risk, but it's also a measure of your opportunity. And there's so many different markets to help manage risk, and we're going to look at a few of those today. Some will protect against the adverse price, some will protect against the adverse price and allow you to benefit should the prices improve. So what customers and you as merchandisers need to do? Number one is you have to acknowledge the fact you're at risk. That's common sense, but there's so many people out there that feel, no, that's not for us. That doesn't pertain to us. I'm here to tell you, risk impacts everyone, buyers, sellers, and merchandisers. Accept that fact, and then you're on the road to recovery. You don't have to be afraid of it. There are so many different ways to manage your risk, and by doing this on a regular, consistent basis, you will be able to conquer that risk. And if you don't manage risk, you're assuming risk. Oh, that's a profound statement, Rich. Yes, it is. But you won't want to see the opposite side. If you are assuming risk, you are now turning into a speculator. And I don't think any of you as buyers, sellers, or merchandisers are in your business to become speculators. So what is market risk? It is uncertainty. There you have 2 market risks, whether you're a buyer, seller, or a merchandiser. One is the futures price, and that is a global price. What does that mean? At any point in time, the futures price impacts everyone in the exact same way. Buyer, seller, merchandiser, in whatever part of the world you are, it's exactly the same. That's a big part of everyone's market risk. But then, as buyers and sellers and merchandisers of physical products, you got to bring that futures price home to wherever you're located. And that's the concept of basis. Combined futures and basis, that's the total market risk that your business faces. So let's take a look at each separately. Futures price from one point in time to another. It could be now in a year, now in a month, now in an hour, now in a second. 3 things could happen to prices: higher, no change, or lower. Think if you wanted to guess where the price is going, you have 1 in 3 chances of getting it right. A little bit of risk there. Let's take a look at your other risk, the basis, your local cash price. Local cash prices can get strong relative to the futures. They can remain the same. That relationship with futures can remain the same, or they can get weaker. The relationship could get weaker relative to futures. Now, sellers want it to get stronger. Buyers want it to get weaker. So again, if you want to guess and you feel that you're pretty lucky, maybe the odds aren't so bad, 1 out of 3. But remember what I said. You have 2 types of market risk to sum up your total risk: the futures and the basis. So now some of you are looking at it and say, what are my odds of getting it right? My total market risk. Well, you might fall in the trap and just do what we did with the previous two slides and say, well, it's 1 out of 6 getting right. That's the most common response, but it is incorrect. Because for each change in futures, for example, if futures went higher, what could happen to the basis? It could get stronger, it could get weaker, or it could remain the same. So for each change in the futures, you have 3 opportunities for change in the basis. So your odds are not 1 out of 6, they're 1 out of 9. And I don't think any of you are in business today willing to take those kind of odds of guessing where the market is going to go. So here's some questions for yourself, and I'll help you with the answers. Will market risk occur? As a teacher, I could say over time, guaranteed. What is time? Again, any period of time. Guaranteed. When will market risk occur? Well, I have to turn that question over to our expert, Jake, but he's on mute, so I'm going to respond for him. I have no clue. Jake doesn't have any clue. No one has any clue where prices are growing. If you ever talk to someone and they say, I know what your risk and when your risk is going to occur, you can walk away. I suggest running away and as far as possible from that person, because no one has a clue what's going to happen in the markets. But there is one solution for everyone, and that's price risk management. So from a grain merchandiser's perspective, the importance of risk management. Offer your customers as many alternatives as possible. If you are a customer, a buyer, or a seller, learn all of the different alternatives available to you. We're going to talk about them in a few minutes here. As a merchandiser, by offering alternatives to customers, you're giving them choice. Customers like choice. And if they see all the alternatives you're offering to them, making available to them, there's a greater chance that you're going to get that flow and could improve your margins and your overall profitability. So let's again look at the foundation. Futures is the epicenter of all risk management. Everything is tied to it. You can use futures as risk management. Allows you to lock in a selling price, a buying price, or for merchandisers, help you lock in spreads. Cash markets. Cash market contracts, the common thing there is that's where the physical delivery occurs. But even with some of those contracts, they're excellent risk management tools. Options, relatively new since the early 1980s. In agriculture, 1984 is when they came about. Instead of being obligated to price, these type of contracts give you the rights, but not the obligations to buy or sell at various price levels. These are the ones that give you protection and opportunity. And the last one, relatively new, probably the most complex. Not that they're more difficult, it's just that they're relatively new. So a lot of education is still needed in this area. OTC for our session today will allow you to create tailor-made risk management products because each of you are different. Each of you have different levels of risk. Each of you have different levels of risk tolerance. And this might be the tool. Now, if I ask you the question, which of these 4 different markets is the best? You should not have an answer. What I encourage you to do is to learn about all 4 of them, the futures, the cash, the options, and the OTC, because at any point in time, one of them could shine above the rest. Learn about them, understand them, learn how to evaluate them, learn how to compare them. And that's the best suggestion I have for you in being successful in risk management. What connects merchandisers to the world? What connects the grain buyer and the grain seller to the world? It's that concept of basis. And it's not just for the American traders, it applies to everyone around the world. Basis is the key to successful hedging, to successful risk management. Mathematically, you'll love this basic equation. I love simplicity. It's your local cash price minus the futures price equal the basis. Basis is one of the most important concepts when it comes to risk management. Now, many of you have probably learned about hedging in the past, whether in a seminar, whether through work, perhaps in a college class. I'm not going to teach you anything different. Even in my full-blown 2-day seminars, I wouldn't teach you anything different from a mechanic or a mathematic perspective, but I do teach hedging differently from a conceptual. And I would like you to think about this concept. If I ask you which of the two sides of the scales was the hedge, many people will say it's the right side, the futures, the options, or the OTC swaps. And if you're like that, because that's how many teachers, professors, brokers try to say it, it's not correct. You're missing a part of the big picture. So I circle what a true hedge is. It's not just the futures, options, or OTC. We'll call that side the risk management portion of the hedge. But another critical part of the hedge is your local cash market position, what you're trying to protect. And it's the net result of the two positions that is the true result of the hedge. Don't be fooled by saying, well, hedge didn't work because I lost money on the right side. Graphically, you'll like this. It just shows a couple things. What I said earlier, that no one has any clue whether a market's going up or down, but with a hedge, losses in one market is offset by a gain in the other. Would you like to have protection against inferior price levels, meaning higher price levels if you have to buy, lower price levels if you sell? Of course, Rich, that's common sense. What about adding something to that? What about having that protection and also having the opportunity to capture better price levels? That's the concept of options. The last one we want to talk about here is the OTC markets. Financial integrity, it's important for all markets, futures, options, cash contracts. Well, we have that kind of financial protection, integrity, if you will, in the OTC markets. Creative and unique products, tailor-made to fit your needs, flexible. Everyone likes flexibility in any concept. Risk management, it's very important. Again, OTC products can help you with risk management as well. So we want you to unlock your potential success with these keys. Learn the cash market, learn all the alternatives. Learn the futures and all those alternatives. But in addition to the alternatives, learn the mechanics, the concepts, the terminology in the futures industry, because as we said earlier, the futures market is the epicenter of all risk management, meaning all risk management somehow, some way is tied to the futures markets. Learn about options, learn about the OTC. Here's the most important key: continue your education on this so important risk management concept. So the merchandiser's bread and butter, and that's where we're going from for the rest of the session, basis and spreads. I'm going to turn this over to my friend and colleague, Jake Moline, and I'm going to turn the controls over. Thank you for your time.
Alrighty. Good morning, everybody. I'm going to try to keep this in the allotted time, get done before 11, because if any of you, like me, are involved in the grain industry, you're well aware that we have a pretty big crop report out here in about an hour or a half hour. So, as Rich said, my name's Jake Moline. I'm based out of our West Des Moines office here. Primarily work with grain elevators, commercial grain elevators, on their risk management strategies and advise them on how to approach exactly what Rich had just said, basis and spreads, essentially. So as Rich said, risk management is important for producers. A lot of you work with grain producers. They sell their grain to you. They want to sell at the highest price. They have risk if prices fall. Their goal is to attempt to cover the cost of production if we're dealing with grain and make a profit. And they're always usually long that physical grain, whether their grain is in their bin at home or whether it's in the field. they at some point do need to sell it. On the consumer side, we may even have some, producers or consumers on the call, whether it's, livestock or ethanol or whoever. On the consumer side, we want to usually buy at the lowest price. We have risk if prices rise. We attempt to achieve, targets and prices and margin goals on the consumer side as well. Usually short the physical grain for consuming grain, meaning they need to buy it. They don't have it, but they do need to buy it. We're going to focus mainly on the merchandiser side of things here today. So those that are in between producers and consumers of grain, a lot of times grain elevators. And we, in the merchandising world, trade basis. We're either long or short basis, and we don't really care which direction the futures price goes. We do to a slight degree, given that it does have some correlation with what basis will do and what farmer selling does. But mainly we're focused on what basis is doing and what spreads are doing. Just to recap on the producer side, they are inherently long or naturally long. They have risk if the market goes down. A lot of grain producers don't think about, the fact that while they're sleeping and the corn market falls 20 cents, they're losing money. They just haven't realized that loss, but they are. So they do have a need to manage risk, a lot of times doing that through cash contracts with grain elevators. They want to sell at the highest price. Their goal is to attempt to cover that cost of production and make a profit. So if you can make money growing and selling $4 cash corn, you should sell corn. So a lot of times we as grain elevators and people advising grain elevators do help producers to develop marketing plans and implement risk management strategies through cash contracts. A lot of times that's called grain origination, and there's a variety of different cash contracts out there, and that's a whole different webinar we could do and spend much more than an hour on the different types of cash contracts and solutions you could offer out to producers. Well, let's take a quick look at what the producer's facing on a day-to-day basis. Let's say this producer does see $4 cash corn and decides to sell December corn futures at $4, assuming, I guess, an option basis here. Let's say these corn futures, after we sold them at $4, fell to $3. And let's say the basis that we locked in was 30 under. That cash price would result in $2.70. You take the $3 D's corn futures minus the 30-cent basis, that equals a cash price of $2.70. Because we sold futures at $4 and we bought them back at $3, you have a $1 gain in your futures P&L to add to the cash price of $2.70, which results in a net selling price of $3.70. If these corn were to not move at all and we had that 30 under basis, your cash price would be $3.70. You'd have a $0 P&L, which would result in our net selling price remaining at $3.70. Let's say futures rose and went to $5. 30 under basis, the cash price is now $4.70. We have a $1 loss on our futures P&L. We would subtract that from the cash price of $4.70 to equal the $3.70. You'll notice the net selling price in all three scenarios here is $3.70, and that's what makes it a hedge. When that producer decided to lock in that $4 futures price, they implemented a hedge, right? The cash position being one side of that, and then the futures sale being the other side. On the consumer side, it's exactly the opposite. They're inherently short. They don't have that product but need to buy it, and they want to buy at low prices. A lot of times they're managing budgets or need to reach certain target prices to want to get long. But bottom line is, if you can sell your output at a certain price and buy your input at a certain price and lock in a margin, you should be doing that. So we do help a lot of consumers as well implement procurement strategies on the buy side as well. We can just look at this from the exact opposite side. Say this consumer decided to buy corn futures at $4 and D's corn fell to $3. Again, that cash price is going to be $2.70. In this case, we're going to have a net selling price or net buying price of $3.70. net buying price of $3.70 if corn goes to $4, and a net buying price of $3.70 if corn goes to $5. All the same. On the merchandiser side, we're not as concerned about what futures are doing, up or down. We are long or short the basis, and we do not care about the direction of the futures market. Why is that? And why don't we just buy corn physically and sell corn physically and try to hope that corn goes up? Well, let's say in this example, we bought corn at $4 cash on June 1st. On July 1st, the cash corn market had rallied to $4.25. That's great. We just made 25 cents on 5,000 bushels in this example. That would result in us making $1,250. But what if the opposite were to happen? Let's say the cash market fell to $3, went down $1. That's $1 loss times 5,000 bushels. That's a $5,000 loss in this example. The reason that merchandisers choose to manage basis risk rather than futures risk, or take on basis risk rather than take on futures risk, is that the futures market is extremely volatile, as Rich pointed out, and it's more importantly unpredictable. Basis is less volatile and it is more predictable. There are seasonal tendencies in basis and usually carries in markets that we can take advantage of by trading basis or being long or short basis. So let's look at this a different way. Let's say on June 1st, we buy $4 cash corn. We hedge that up by selling futures at $4.25, okay? And then on July 1st, we decide to sell that physical corn. The price is $3.50 at this point. We lost 50 cents physically. But on July 1st, we lifted our futures hedge, and the futures market had dropped to $3. We sold at $4.25 and bought at $3. We made $1.25 in that example, resulting in a 75-cent gain per bushel. Times 5,000 bushels, that's $3,750. That's a confusing way to look at it. The way we are always looking at it is on the basis side. You see this basis column here in the bottom table. When we bought physical corn at $4 and hedged that up at $4.25 futures, we locked in or became long basis at 25 under. You can see that the physical price minus the futures price is negative 25 cents. So we're long basis at 25 under. One way to look at basis, and just to try to remember whether you're long or short basis. So when you bought physical corn from that producer, you became long physically. Your basis position, if you're hedging, is going to be the same as your physical position. So because we own corn, we're long the corn, we would sell futures and then become long basis. So you can see we owned basis at 25 under on June 1st, and then on July 1st, when we sold out of that physical corn, the basis was 50 over. You take the physical price of $3.50 minus $3, that's a positive 50-cent number. If you add those two numbers together, that results in the 75 over number, or the 75-cent gain number that we calculated in the top table. But we're never really looking at the physical gain or loss. We're just looking at the fact that we're long basis at 25 under, and our goal is to sell a better basis than 25 under. So what is basis? In its purest form, basis is just a function of local supply and demand, and also transportation in our local market. It is not the elevator's cut. I'm sure a lot of you who deal with producers on a daily basis sometimes hear them try to phrase it this way, but just because your cash price is 40 cents below the futures price does not mean that the elevator is making 40 cents a bushel. You know, they're not able to turn around and sell it at the futures price physically right away. You guys understand that more than likely, but a lot of times producers have a difficult time understanding that. There is seasonality to basis. That's why we have a lot of advisors out there advising grain elevators on how to trade basis, and we look at historical seasonality when we're trying to make decisions on where to buy basis and also when and where to sell basis. And it's a lot more predictable than the futures market, and that's how we're able to make money on a consistent basis. There are different futures months when we're talking about basis. For instance, in the corn market, you have Dece corn, March corn, May corn, July corn, Sep corn, and basis will reference all these different futures reference months as you look out at the deferred market. A farmer in general who is selling cash grain wants a higher, less negative basis, stronger or firmer basis. There's a lot of different terminology. An elevator who's buying grain from that farmer would like to purchase that at a wider, weaker, or more negative basis and later sell that grain at a narrower or stronger basis because that's how we're making money. I like to think about basis like a thermometer. As you can see on the left here, we got a couple different terminology. You got strong or narrow basis, and then at the bottom you've got weak or wide basis. The numbers on the bottom you'll notice are negative. In that case, the cash price is less than the futures price. And if we have a positive basis number, it means that our cash price is above the current futures market. So if you had December corn trading at 370 on the board and the local cash price was 330, that's a 40 under basis number. We like to buy physical basis when it's weak and sell physical basis when it's strong. This chart here shows a kind of a neat little map of the different basis values across the U.S. for corn back in 2015. And you can see in the legend there we have basis numbers ranging from $1.25 below the current futures market or as much as $1 higher, right? So when you look at this map based on the color coding, what do you think is the firmest basis value locally or geographically on the map? You can see it's down here along the Mississippi River, close to the export market. They're posted at between 11 over and 25 over in that area. You can see in the eastern corn belt we're dealing with a firmer basis than we are in the western corn belt. You can see a lot of green and yellow over there, and that's because, again, a function of local supply and demand and their transportation costs to get to that firmer basis area or the export market are lower than in the Dakotas, for instance. As you look out in the Dakotas, there's not as much local demand in those areas, not as much local ethanol plants, consumption. There's more production than consumption versus the other areas of the Corn Belt, and it just costs more to get to delivery points and or export markets. This is a map of the current basis that we're looking at in corn today. The dark purple bar graphs, and this is kind of a 3D map, show a positive basis number, whereas the light purple would be below ground or negative basis numbers. You can see in the eastern corn belt, in Indiana and Ohio, we're dealing with some very, very strong basis levels, well above the current futures market. And you also see areas up in northwest Iowa there that are dealing with some firmer basis levels as well. These are all areas that had lower production last year. They were production deficit areas or areas that were delayed in planting this year and areas where farmer selling has been very, very slow. So the local supply of available grain is lower than the demand, and end users are having to pay more for grain in order to buy it in those areas. One neat thing here about how efficient the grain market is basically grain is going to flow wherever it needs to, and basis is how that happens. So let's say in Minnesota, they're posted 37 under May futures. That's what that K stands for. And let's say we're looking at shipping some grain out on a train all the way out to the PNW, and we're going to ship that out to Asia. Once that gets out there, you can see that the basis number out in the PNW is 65 over the May. The difference between those two numbers is $1.02. Okay, they need, basically that's the cost of the freight to get it from Minnesota all the way out to the PNW. If we're looking at say southern Minnesota, they're posted at 36 under the May. Let's say they're going to put some grain on the river or on a barge and ship it down. Let's say there's another elevator in Iowa that's posted 15 under. The difference between those two markets is about 21 cents. So it costs about 21 cents to get it from southern Minnesota to this area in southeast Iowa or Illinois. And as we work our way further down the river, the basis is generally going to get firmer as we have less freight costs to get it to this export market at 35 over. The difference between that area of Iowa or western Illinois and this Gulf market is 50 cents. That's the cost that it would take to get it to the export market. So when we can buy basis in Iowa there and put it on a barge and ship it out to the Gulf, and it costs us less than 50 cents to do that, we're making money. And that's what's going to cause grain to flow from southeast Iowa to the Gulf. So how, as a grain elevator or a grain buyer, are we calculating what our posted basis should be to the producer that we're attempting to buy grain from? Let's say we're located in Iowa. We've got an ethanol plant down the road. We've got a terminal that's on the river down the road as well. And then we've got our elevator. And let's say we're competing with these different areas, but we're also customers of theirs. When we buy grain from a farmer, we're more often than not going to be selling this grain to either this ethanol plant or this terminal. And their posted basis levels at this point are 30 under the Ds and 25 under the Ds. That's what that Z stands for, is December futures. Let's say our freight to get the grain to the ethanol plant is 8 cents. And let's say the freight to get it to the terminal is 10 cents. And let's say we build in, which we always do, build in a back-to-back margin to where if we were to buy it today and sell it today to that end user, that terminal, we're going to make that much money. And let's say that margin is 10 cents. So the delivered value, or the value that we would need to post basis at to buy grain from the farmer and sell it to this ethanol plant back-to-back and not lose money or make our 10 cents is just a sum of those two. So you take the 30 under number, you subtract off the freight costs and the margin, that gets us to a 48 under the D's posted value. You can see the terminal is 25 under. We've got 20 cents worth of freight and margin to build in there. That's 45 under. So we might be an average of the two. It's not an exact science. We might post 47 under. We have to be competitive with our local market, but we also have to make sure that we're owning basis that we're comfortable with and that we can make money at. So it's important for us to realize that there are different futures months that we're referencing when we're talking about basis, okay, that reference different time periods. And it's vital to know which futures month that your company's basis is referencing when you're talking about it. So let's say we're looking at the fall time frame, okay, October, November. It's usually the harvest time frame. If the cash price that we're posting is $3.20 and the December corn futures are at $3.50, that means we are 30 under the Ds for Ocnove delivery. In March, or let's say in January, the calendar month of January, we're going to be hedging versus March futures. And March futures are at $3.57. Our cash price for January delivery is $3.32. We're going to be dealing with a 25 under the March basis in that time frame. Let's say for March and April delivery, we're referencing May futures, which are at $3.65. Our cash price is $3.45. That is 20 under the May. So you can see that there's a carry in both the futures market, meaning the deferred months are higher, and in the cash market. And that cash market carry exceeds the futures market carry. And we want to capture that carry because the market is willing to pay us to hold that grain off the market. This chart here just shows a seasonal look at what corn basis tends to look like. You can see we've got some different lines here. The December, March, May, July, Sep, those are the different futures reference months. And then you have the basis, which is displayed by this blue line. And then the y-axis is basis, and then we have the dates on the bottom here. And this is just what basis did in 2017 in Cedar Rapids, Iowa. You can see in the fall time frame from like September through late November, basis tends to be the widest. It's referencing these futures, and that's when we have the most supply on the market. We have just harvested our grain. It's all being put into an elevator, and demand tends to be pretty consistent throughout the year, whereas supply is not consistent. We have the most supply at the beginning, which means basis is going to be the widest. So our goal is to buy as much grain as possible at these wide basis levels in the fall and be able to gain this basis appreciation that you see in the upward sloping blue line here. Let's walk through one example here. On November 23rd, let's say we bought physical grain at 353. We hedge that up versus July futures at 395. That means we own basis at 42 under the July. Let's say on July 6th, we decide to sell that physical grain at 379. Futures are at 386. At that point, July basis is at 7 under July. This means that we made 26 cents physically, made 9 cents with futures, and we gained 35 cents in total. We owned it at 42 under and we sold it at 7 under. If we paid 14 cents in interest and storage and had a 6 cent built-in margin, that means our net hedge gain would have been 15 cents from that. One more example here. Let's say we bought physical grain in October, hedged it up, we own that at 59 under, and let's say both the physical and futures markets went up. We gained $1.06 from our physical position. We lost 62 cents from selling futures at 9.45 and buying them back at 10.07. But the net result is we gained 44 cents because we own basis at 59 under and we sold it at 15 under. I'm going to skip past this example here due to time constraints. One of the things that a lot of merchandisers will ask is, if I hedge a bushel using December futures, do I have to sell them by the end of November? No. You can roll that position out into a carry market if you'd like. You can see the difference between the D's futures and the red line here in the March futures is about 12 or 13 cents in carry. So we calculate market carry kind of like how we calculate basis. We're going to take our spot reference month, or the more nearby reference month, minus the more deferred, and that's how we're going to calculate our carry. So you can see that March futures are trading 7 cents higher than D's, that's a 7 cent carry. May futures are trading 8 cents higher than March, that's an 8 cent carry. The market is paying us to hold that grain off the market and sell it at a later time frame. You got 3 months between D's and March and 2 months between March and May. So if you took D's minus March, 350 minus 357, that results in a negative 7 cents. Carry is always displayed as a negative number. We have 7 cents worth of carry between D's and March. Sometimes we have an inverse in the market, and that's when the more deferred months are below the spot months. In this example, you can see Jan futures are at 9.50, March futures are at 9.45. That's a 5 cent inverse. What the market is telling you is they want the grain now, and you should not hold on to it because we're going to pay you less for it in the future. In this example, we're dealing with a 10 cent inverse, positive 10 cents. So how do you decide where to place your hedge? Well, you would calculate the cost of carry and the amount of financial full carry in the market, and then the percentage of full carry that spread's at. So in this example, let's say we got $4 cash grain. We're going to calculate the interest by taking 3% divided by 12. 12 months in the year to get to a monthly interest cost times the number of months. And then we have a storage rate of about 8 cents a month times 3 months. That's how we're going to get to our financial full carry. So the interest cost here, 24 cents plus the storage cost is 24 cents plus the interest. We get to 27 cents as financial full carry. So a lot of times we're looking at the percentage of full carry, and we're also looking at seasonals on when to decide to roll our grain forward, or if we want to roll our grain forward rather than selling it today. You can look at that seasonally, like the left chart here, as a numerical value, or you can look at it as a percentage of full carry. In general, the market is never going to exceed a certain percent of full carry. Otherwise, people will take delivery, hold that grain off the market, and sell it for a deferred time frame and just print money. There's no limit to the amount a market can go to in inverse, while there is a limit to the amount of carry that can be in a market. So if we own corn at 20 under the D's and we rolled it forward at a 13-cent carry, we would own it at 33 under the March. Let's say there's a 9-cent carry to May. We now own it at 42 under the May, and let's say we could sell at 2 under the May basis number. That would result in a 40-cent margin. That's kind of what our goal is as a grain elevator. So I know we wanted to have some time for questions here. I do want to mention that we are holding it's difficult to get through these types of concepts in an hour, but we are holding a GEAPS Academy for newer merchandisers in Chicago here towards the end of this month, July 24th and 25th. People attending this webinar can enter this discount code. You might want to write this down if you have some employees or you yourself are thinking about registering for this. GEAPS2 for $150 off the registration. You can just go to intlfcstone.com under events and find this. It's July 24th and 25th. It's a 2-day seminar in which we're going to get a lot more in detail about grain merchandising, the concepts of basis and spread, being long basis, short basis, and spend some time on options education as well as grain origination as well. But I want to thank everybody for their time today. And Kendall, if you want to take back the reins here, and we can do a little Q&A before everybody breaks off here for the USDA report.
Certainly. Thank you both, Richard and Jake, for a great presentation today. We will now take a few questions. If you have not yet submitted your questions, please do so at this time. Okay, one moment, please. My apologies. There we go. Our first question. What would be the 3 main reasons for a grain merchandiser to hedge grain versus buying and selling back to back?
Yeah, I'll handle that one. The main reason would be basis appreciation and the seasonality and basis and the carry in a grain market. It's just going to enhance the margin that we make on that grain and add to the bottom line in short. Another reason is it does give you more power in the negotiation process between when you sell that physical grain to, say, an ethanol plant or an end user. When you hedge up grain and you call up an end user and decide you want to sell it, you're talking basis with that end user. You're not talking flat price. So you're negotiating the basis that you're going to sell to them. And when they know that you have that grain hedged up, that you're not at risk, you don't care what the futures market's doing, and you're able to kind of combine bushels together. You generally don't purchase large quantities of bushels that we would sell to an ethanol plant at one time from a farmer. So we're able to accumulate small purchases and then make a big sale to an end user and maybe negotiate with that end user about the basis that we're going to sell to them. We're able to pick up carry in the market by hedging grain and rolling that out forward and not being at risk to price movement in futures. And then one last thing is we're able to offer risk management tools to our customers, the grain producer, embedded into cash contracts, whether it's futures or options. We're able to offer them solutions that are going to help us originate grain.
Okay, we'll just do one more question here since we're short on time. What are the benefits of having a risk management consultant?
Well, I'll step in. This is Rich Jelinek, and Jake, hopefully you could add a couple of comments. But everyone on the call, whether they're buyer, seller, or merchandiser, they have their core job, their main responsibility. Following the markets, all the markets that we mentioned, from the agriculture to energy to interest rates, those markets are a job in itself. And most large companies will have somebody that just follows each one of those segments. So it is very important to have a risk management consultant as part of your team to follow and be able to advise you of what's happening in the markets, advise you on how to help manage those risks.
Okay, that is all the time that we have for questions today. I want to thank everyone for their participation. If your question was not answered, we will send it forward to our presenters. And that is all that we have for today. I want to go ahead and thank our sponsors, M&M Specialty Services and VAA LLC, for their support in bringing you today's webinar. And I also want to thank GEAPS and our presenters, Richard Jelinek and Jake Moline, for joining us today. The GEAPS Leadership Education and Networking Workshop offers new grain industry professionals and experienced leadership alike an opportunity to sharpen leadership skills, gain practical insights, and expand their professional networks. All grain industry professionals, GEAP members, and non-members alike are invited to attend. The workshop will be held at the Intercontinental St. Paul Riverfront, July 16th and 17th. Please visit jeeps.com for registration information. As a reminder, this webinar has been recorded and it will be available for viewing on grainnet.com within 24 hours. All registrants will also receive an email containing a link to our webinar recording. Our next GEAPS educational webinar will be held on Wednesday, August 21st at 10 a.m. Central Time. Quinn Vincent of VAA LLC will be discussing rail design, on-track insights for your site. I want to thank you all for attending, and I wish you all a great day.